Hey, good morning, everyone. Marty Mazzori here. It's Friday, May 12th, 2023, with your end of week market snapshot. Got a few things I want to share with you today. Want to go quickly, don't want to take up too much of your time. I do want to mention, however, one of the inputs to our index that came out this morning, and it's the University of Michigan's Consumer Sentiment Survey. We actually score or track a couple of them, that one and the conference boards. This one wasn't good at all. The headline score was quite low. Consumers are not feeling good about their go-forward prospects, and they're also not feeling good about inflation. They actually see their financial prospects or their economic prospects waning while inflation continuing to rise. And make no mistake, the Fed is intently concerned about inflation expectations. So on that news, the S&P was up, a decent amount early on, and it rolled over, and it's just barely in the red as we speak. The NASDAQ 100 as well. Yeah, you would expect the market to struggle with that kind of news, but one might expect to a much greater degree than what we've been seeing. And this all comports, by the way, at least the sentiment survey does, with what we've been talking about here for the last several months, particularly on the economic update. As I've been suggesting in our technical analyses and, of course, our view of general conditions, we think odds favor the market suffering to a much greater degree ultimately before this is all said and done than what we've been seeing of late. But I want to get into just the quality of the rally, talk again about breadth and so on. So without further ado, in front of you is the price chart for the daily S&P 500. Each candle is a day, and that taking us back to the top, the all-time high, and where this market rolled over into the current bear market. The S&P is still down just over 10%. For the bear market itself, the NASDAQ is still down in the teens. Both are up pretty nicely so far this year. As I mentioned, we'll look at the quality of that rally. On just the price chart, as you can see, we're back testing once again this all-important 50% retracement of the bear market, right? Went down, bottomed right here on October 16th of last year, and we've come halfway back. Very key level is that 50% retracement. Most bear markets see that kind of retracement. Often they get even to the 62% retracement, if not higher. But right now, what do we have? We still have lower highs, although we've been rallying out of here. Again, our base case remains that this is a bear market rally. But to be fair and give those who are bullish the market equal time here today, I do have to point out that the 50-day moving average has crossed above the 200-day moving average more often than not historically. That spells the end of the bear market. The 50-day moving average is sloping higher. 200 days trying to at this point. And we've come back here recently and successfully tested the 50-day moving average. Very bullish, no doubt about it. Other than that, though, we've had just the same pattern that was building right here, rising wedge before the market fell off. But like the last two attempts to break out, we failed and bounced against that area a few times, and we're doing it here as well. So we'll see. I think the bulls would argue that the more you pound against that resistance, you'll weaken it and you'll finally break through. You could say this is kind of looking like an ascending triangle pattern, which would be a bullish pattern as well. Our issue really is when you look at the momentum indicators that we like to chart, and that is the moving average convergence divergence and the RSI. So the other thing that's consistent with this bear market, and these are patterns we've been drawing for years now for you here on these videos, and you can see they're really good indicators. Nothing is 100% ever, and these divergences in and of themselves aren't buy or sell signals, but they're basically signals of a weakening of the current trend. When you have, for example, a bullish falling wedge right here, right, building, and then you have a positive divergence here on these two. Very, very bullish setup. We were looking at this then, talking about the likelihood, and sure enough, we got that. But then we moved into, right, your bearish rising wedge, right? Didn't have really divergences here, but we quickly got our sell signal. Then when we came back and tested it, we had very dramatic divergences, and of course that fell apart, although it got caught right here, consolidated for a while, got bullish, came back up. Here we were at this top, looked a lot like this one, although tested it a third time, and then rolled over, but caught itself right here. So this will be, if we're right, this 3,800 mark will likely prove to be some support, at least for a while, on the market. Long story short, right now, we've broken out of that rising wedge, but we're fighting like crazy. The market is to break out above this retracement, but what's going against it is some very waning momentum. Probabilities point to this ultimately failing, but of course, that remains to be seen. Jumping to the daily on the QQQ, which is the ETF that tracks the NASDAQ 100 index. This one I said is about as bearish a look as you can get, certainly for this index during this bear market. But again, we just have this long lasting divergence here. We do have a buy signal here on the MACD with this latest thrust higher. And again, and I do circle these and pay attention to them, I'm really more interested, the way I look at the technicals, at the slope of the indicators. I mentioned the dollar this last week, and I said, longer term we're bearish the dollar, short term technically we are bullish the dollar, right? So you had your falling wedge, you had these bullish divergences in here, and sure enough, we're getting that upside pop here the last couple of days. Why is that concerning? It's just the way the market is trading these days alongside the dollar. So this is just the last 3 days. And again, it's not perfect, but if you just kind of track this, right, you see back here on Wednesday, and Wednesday was when we got the CPI numbers, right? So you've got the fall off in the dollar, right? And both responding to the inflation numbers, obviously, but you see how the counter correlation works here. Here you have the dollar coming back, you have the market coming down, right? Here you have the dollar coming down, you have the market spiking higher again. So clearly, as the trading goes currently, there is somewhat of a negative correlation. So when I do our monthly equity market conditions index and I show you a relatively short-term bullish pattern on the dollar, well then I'm saying that is scoring a negative in our index, and this kind of illustrates for you why, right? Just look at the slopes here, right? And then here we are today. Here's S&P futures rolling over. Here's the dollar turning higher. Okay, so when I show you a technical pattern that looks to us short-term like the dollar could go higher or lower, then that has implications for the market, the way it's trading currently. We'll jump on breadth and then we'll get on with it. So year-to-date chart, the S&P 500 cap-weighted index up 7.5%. Okay, so hey, the market's up 7.5%. Well, is it really? What if we took the S&P and we gave all 504 positions, I believe it is, equal weighting? Well, we're basically flat on the year, coming off of negative on the year, and notably negative just the other day, right? So stocks are a zero so far this year if you look at the S&P on an equal weighted basis, which means just a handful of stocks are moving it. Now, sure, maybe they pull everything up, but typically this is not a healthy look. And when you track this historically, you find this kind of divergence and heading into tech bubble bursts and things of that nature. So kind of a warning sign, the way we view it. Another look at breadth is the advanced decline line. So it goes up when there's more advancers than decliners, goes down when there's more decliners versus advancers, and you look for divergences here. This has been a real good indicator for us long term. So you can see on the S&P, not a great look from an advanced decline standpoint either, which makes perfect sense based on what I just showed you on the equal weight versus the cap weighted index. Number of stocks trading above their 50-day moving average. I just showed you how bullish the S&P looks relative to its 50-day moving average. Well, less than half of its constituents are actually trading above the 50-day moving average. Not a good sign. You can see on a slow moving basis here how historically, that's probably not a real positive indicator either. Same look on the 200-day moving average, right? You can see here, right? We've got a real negative divergence. We've got the S&P way above its 200-day moving average, and we don't even have half of its constituents above its 200-day moving average. One of the ones that's most dramatic that really confirms that bearish look to me on the NASDAQ. Now here is the NASDAQ comp, and here is the NASDAQ comp index going higher during this period, and the advanced decline line just brutally rolling over hard. Just not a good picture for the bulls right here. I'll leave it there. Thank you, as always, for watching and listening. Be back either this evening or over the weekend with your economic update. Take care. Bye-bye.